Gave y'all a good website, stockmarketwatch.com, uh, yahoofinance.com, high beta, low beta, what to expect between those. Talk about PE ratio twice. The last video, and I talked about it the video before that. So y'all should have a good understanding of the PE ratio. But the next one that we are going to get started on is the standard deviation. The standard deviation measures how much a stock price fluctuates from its average price. And I got that definition from Robinhood. To me, standard deviation means it just shows how risky a stock is and how much risk that you take on. The standard deviation for the standard number for deviation will be a standard deviation of 0.1. So if it's higher than 0.1, you would take on more risk. If it's lower than 0.1, you would take on less risk. Me preferably, my personal risk tolerance in my portfolio is 0.2. I once was in a stock that was at a standard deviation of 0.488, and I believe that stock was right. Highly volatile, high beta, high risk, very risky stock. The price dropped from 79.50, and now today it is worth 29.36. So the higher that standard deviation, the higher risk that you take on. Like I was saying, more risk, high risk, high reward, low risk, low reward. But what do we want? We want that low risk, high reward investment and stock. So this is a way to calculate the standard deviation or calculate your risk tolerance, like the beta, the P ratio, standard deviation. These are all ways to calculate your risk tolerance. Like I was saying, very risky stock. AMC, very risky stock, meme stock. All people did was just push the price up. It's not much money fluctuating out here anymore, so people don't have the extra money to play around with to invest into these companies in debt and push the stock price higher than what it should be. So AMC standard deviation right now is 0.75 compared to a great company called Apple, which you all know. Apple standard deviation is 0.08. Low risk investment, but you can potentially get a high return from Apple. They consider all the great stocks, great companies, they consider those stocks slow and boring. I told somebody I was investing to Apple. He said, "Man, you boring," and he was investing in AMC. And I looked at him. I told him, I said, "Man, I was like, that's fine." I was like, because I have that same return that you had in AMC in one day. I have that same return from Apple in 1 year plus dividends. So time in the market beats trying to time the market. So don't try to just invest for a quick buck. Invest to actually make a difference in your life. Now I'm gonna go to the website. Let's see. So stockmarketwatch.com, like I was telling y'all, we're gonna look at the S&P 500. One of my favorites all time. I invest in every week. It's either that or Apple that I invest in every week. Just depending on how I'm feeling. So you'll pretty much go to the stockmarketwatch.com to look at the risk stats slash ratios. It gives you beta, standard deviation, and the standard deviation of S&P 500 is 0.04. Reason being, the people that's been paying attention and actually listening to the videos and applying the material, you would know that the reason being for this low standard deviation is because high diversification. S&P 500 has over 500 companies in it in different sectors of the market. So standard deviation is a great tool to measure your risk tolerance. Let's go to, like I told y'all, AMC standard deviation was 0.75. Let's look at GameStop, another meme stock that people loves and talks about. The standard deviation for GameStop, oh my goodness, 2.10, extremely high, and a negative beta. And we talked about the beta, and a negative beta means what? An inverse relationship. So that's crazy. That's crazy. We saw the SPXS, the S&P 500 bear short, has a negative beta. I didn't know this stock had a negative beta. That's crazy. but you take on a lot of risk in this stock, as you can see with the standard deviation at 2.10. That is that's crazy. I did not know that. I was looking at another great company, standard deviation. So you just go there and you hit performance. You can scroll down. So Square, aka Cash App, everybody uses it. Great business, great company. Has a standard deviation of 0.15. My personal risk tolerance is 0.1. Well, not 0.1, 0.2. So anything over 0.2, I don't invest in it, just depending upon the company. Whew. I did not know that was that high. GameStop is really risky. The price is at $169 right now. It should not be there. Company really in debt, closing stores all around the United States. They don't even know what direction they're headed, but if they do take a direction into the future, they might be a great company. Just going back to it. So price to book ratio, it pretty much compares a firm's market value to its actual book value, aka net value. Using PB ratio is a good way to tell if a stock is considered overvalued. Book value is how much a company will be worth today if they sold all their assets, aka tangible assets, which is cash, real estate, and machinery, and paid off all their liabilities. And PB ratio isn't great for every company to use. Um, Reason being because some of those tangible assets, like cash, real estate, machinery, may not be used as much with a technology company. So I wouldn't necessarily use the PB ratio for a technology company. I'll more so use the PE ratio. PB ratio indicators: one undervalued, less than one undervalued, less than three fair price, and higher than 10 overvalued. A high PB ratio isn't always bad, depending upon the company. Investors are willing to pay more for the stock price. Had the burp. Excuse me. But with that being said, if they are willing to pay more for the stock price, what was I getting with this? Oh, they're willing to pay more for the stock price. So, say for instance, Tesla, great company, high PE ratio. They're more than likely have a high PB ratio because investors are willing to pay more for that stock because they believe that Tesla will be a great company in the future. With the undervalued PB ratio, this possibly means that investors are overlooking a company that has potential growth and value. One company that has great potential growth and value, if they just get with the program and get with the technology side of things nowadays, is Kroger. So I'm gonna take a look at Kroger, and their PB ratio may be low as well. So negative PB ratio means a company is badly in debt. Like I was telling y'all, GME, GameStop, aka GameStop, AMC, those are companies that are in debt. So you would pretty much assume that their PB ratio is negative. And if it says NA on the Market Watch, on MarketWatch.com, it pretty much has a negative PB ratio. Because if they had a positive PB ratio, they would show the actual PB ratio on MarketWatch.com. Let's see. So book value equals assets minus liabilities. They do the equation for you. They come up with the price to book ratio for you. So no need to do all of that or the calculations. I'm just giving y'all the formula. MarketWatch.com, you can find the PB ratio on there. That's the end of that PowerPoint slide. Let's see. So what I tell y'all, I told y'all MarketWatch.com. That's where I go to look at my PB ratio. I'm pretty sure you can go to Yahoo Finance or you go to StockMarketWatch.com, but I go to different websites to look at different stuff. So let's type in AMC. Let's see what the PB ratio for AMC is. And you just click on profile. So the PB ratio for AMC is NA, like I was assuming. These are bad numbers. You don't want to invest in a company that is mainly negative numbers. Reason being because these companies are in debt. They're not making money at all. You see they have a negative price to book ratio. Only reason this price is that the price of AMC is at $34 right now because extremely high volume, high volatility in the stock. I've talked about that with my ICE investment members, so no need to go too deep in that. I want to see if GameStop even pops up. GME. Let's see it, baby. You're going to have a positive beta. I mean, price to book ratio GameStop. Let's see. They're going to load. Yep. So they have a price to book ratio of 48, extremely overvalued. These are negative numbers as well. They're not in as much debt like AMC, but they are in debt. And they probably made so much money off the GameStop frenzy that happened this year. So they probably gave them investors probably gave the company more money to work with and actually to play with to try to like pay off that debt because I know that's what AMC did. That money that everybody flooded in AMC stock, they used some of that profit to pay off the debt. And like I was just telling y'all, Kroger has a not negative, but a low PB ratio. Like I said, less than 3 is fair price. Less than what I say, less than 1. I forgot what I said. Let's see what I said. Yeah, less than 3 fair price, less than 1 undervalued. So with that being said, Kroger has the potential to become a even greater company. So remember, guys, to invest, invest, invest. Don't just sit here and watch the videos. Don't just go sit here and go rewatch the videos. Make sure you're taking notes, actually applying the material. Don't just talk about it, be about it. That's the only way you can create that long-term generational wealth or just wealth for yourself. It doesn't matter. I want you all to go take this material and actually apply it. You can talk all you want. You can read all you want. You can watch all the videos that you want. But if you don't actually apply the material and actually take the time out to invest, it won't matter. If you have hella money and you only invest in like $10 when you can invest $80 a month, then you're not really trying to set yourself up for the future. So remember, guys, to go execute, invest, and shine, baby. That's all it is to it.